Hello and welcome. This is going to be a financial analysis of two publicly traded companies, Coca-Cola and PepsiCo, by Bao Vang and Matthew Yang. As we compare these two companies, we will be covering their shareholders, why their investors care about cost of capital, cost of debt, cost of equity, overall cost of capital, the effects of financial restructuring, debt risk, other competitors, and fairly stated stock prices against the market using the intrinsic value. In addition, we will have our conclusion at the end based from the analysis on which company is a better investment. Who are the shareholders? Shareholders are an important aspect to any company because they bring various benefits with their investments. By investing their cash, they can contribute to the company's finances and help the company grow. By viewing both Coca-Cola and Pepsi shareholders, we concluded that both were in the same range for the shares outstanding and the number of holders and ownership activities. In addition, both Coca-Cola and PepsiCo have many of the same institutional owners, institutions such as the Vanguard Group Inc., BlackRock Institutional Trust Company, Bank of America Merrill Lynch, and Fidelity Management Trust Company. However, PepsiCo expressed a stronger relationship in the number of institutions holding shares in the company. We believe this was the case because the confidence of return PepsiCo has over Coca-Cola to their shareholders. Therefore, based on the information solely, we conclude PepsiCo is a better company to hold a position. Why do investors care about cost of capital? We break this down into 6 different areas. Advantages of debt financing, disadvantages of debt financing, tax rate, ability to pay interest, variance in operating income, and default spreads. The cost of capital is an important factor for investors because it gives investors the sense on how equity and debt flows through a company. This information allows investors to review the financial risks of the company, the potential of growth, and the rate of return they will receive. Advantages of debt financing. A company can borrow money to meet the needs for the company to stay afloat. A tax reduction can be applied because it can be seen as a business expense. And short-term investments can be reached to improve the future of the company. Disadvantages of debt financing. The repayment plan for the loan taken, credibility of your firm making a profit within the business world, and competitors taking advantage of it. Tax rate for both companies. Coca-Cola's tax rate is 24.5% and PepsiCo 26.8%. These tax rates were taken from the annual reports given from each website. We weighted the ability to pay for interest for both companies using EBITDA, interest coverage ratio. In conclusion, Pepsi had an 11.32 and Coca-Cola 28.43. Variance in operating income. Variance in operating income can either be favorable or unfavorable. This explains if a company has excess amount of budget that is over the amount incurred, which can relate to the revenues or expenses. Examples of a favorable variance would be a higher revenue level or a lower expense level than expected. Default spreads. To increase the bond ratings, a company must increase their debt ratio to the optimal debt ratio. By looking at the chart below, we see that Coca-Cola has a debt to equity ratio of 0.03% and a bond rating of AA-. According to the chart given on Damodaran's chart, the current debt ratio for PepsiCo is 3.74% and a current rating of B. What is our cost of debt financing? A cost of debt is important because it measures the riskiness of a company and assists investors in comparing a company's risks to another. For both companies, we broke it down into 2 sections, cost of debt pre-tax and cost of debt after tax. In calculating the cost of debt pre-tax, the risk-free rate for a 10-year bond added to default spread in accordance to each company. The result for Coca-Cola is 3.15%, and the result for PepsiCo is 8%. In calculating the cost of debt after tax, the cost of debt before tax is multiplied by the tax rate minus 1. The result for Coca-Cola is 2.38%, while the result for PepsiCo is 6%. In conclusion, based on the information gathered from above, the better company to invest would be Coca-Cola because both the pre-tax rate and cost of debt is better received than PepsiCo. What is our cost of equity financing? A firm's cost of equity represents the compensation that the market demands in exchange for owning the assets and bearing the risk of ownership. In theory, it is the return that stockholders require for a company. By calculating the CAPM, or the capital asset pricing model, which describes the relationship between risk and expected return, the cost of equity can be concluded. We use the regression formula from Excel and the expected market return retrieved from Demodouron's website to construct the CAPM for both companies. Coca-Cola received a 6.95%, while PepsiCo a 2.19. The information we gather for Coca-Cola and PepsiCo explains that Coca-Cola would be a stronger investment than PepsiCo. Because the strength of Coca-Cola's CAPM is stronger in the return their stockholders receive than PepsiCo, and the betas calculated, which includes the bottom-up beta, holds stronger as well because Coca-Cola only deals with beverages while PepsiCo is in the beverage and food processing business. The next few slides are graphs related to the information given from the Excel regression. Coca-Cola's versus the market 5-year return. This displays the relationship of a beta of 0.4592 compared to the market for a 5-year monthly return. This is PepsiCo's against a 5-year monthly return against the market. This shows the relationship of a beta of 3.4% compared to the market. This is a graph displaying Coca-Cola's market for a 2-year weekly return with a beta of 0.3068. This is Pepsi's graph displaying against the market with a 2-year weekly return with a beta of 3.4%. Next, we use the bottom-up beta. A bottom-up beta is estimated by starting with the businesses that a firm is in, estimating the fundamental risk, or beta, of each of these businesses, and taking a weighted average of these risks. This method works well because they are more precise. We determined that both companies had market segments in beverages. However, PepsiCo had a segment for food processing. We gathered the information for PepsiCo on the annual reports from their website and the market beta from Demodouron's website. Our calculations resulted in Coca-Cola having a bottom-up beta of 0.8 and PepsiCo of 0.83. What is our overall cost of capital for both companies? The cost of capital of a company is important because it helps evaluate the capital needed to build new facilities, expansion, and growth in relation to debt and equity. We have gathered financial statements for both companies from Yahoo Finance and calculated the WACC for both to compare. The cost of capital is the weighted average cost of equity, debt, and preferred stock. The WACC for Coca-Cola is 3.98 and PepsiCo is 14.5%. Yet again, with the information gathered for both companies, Coca-Cola is the better choice because it has a lower WACC. This expresses that Coca-Cola is creating more value than PepsiCo and looks more appealing to investors. In addition, Coca-Cola is performing at a lower ratio than PepsiCo in all categories expressed above. How would a financial restructuring affect the value of the firm? From gathering the information given from Demodouron's Excel spreadsheet, we received these results. Generated from the analysis indicate that Coca-Cola were to increase its current debt-equity ratio from 0.03% to 0%, the firm's value would decrease from 165, 459, 450 billion to 165, 453, 627, 488 billion dollars. As for Pepsi, the results suggested by the Excel formula that it would be increasing its debt equity ratio to 2.70 to the optimal ratio of 60%, which causes a negative effect to the growth of the company. PepsiCo's value would decrease from 11,514 billion to 642 billion on a perpetual growth basis, which results in a net loss for PepsiCo would be 4,872. In conclusion, by changing the capital financial structure of both companies, Coca-Cola would overcome the defaults that PepsiCo has with its restructuring. Although both companies resulted in a negative effect, Coca-Cola received a lower impact on the firm. Would more debt create unnecessary risk? Coca-Cola is operating at a higher debt-to-equity ratio than what the optimal level is, but decreasing the debt would decrease the firm's value. Therefore, Coca-Cola should remain at its current level. PepsiCo operates with high revenue, which in return gives it a negative effect if debt ratio increased. The only benefits would be a tax exemptions. We found that the only competitor that was applicable to both Coca-Cola and Pepsi was Dr. Pepper, since Coca-Cola solely operates in the beverage sector. As shown above, the statistics reveal that Dr. Pepper is a much smaller company compared to both Coca-Cola and PepsiCo. The market cap of Dr. Pepper is about 7% of Pepsi and almost 5% of Coca-Cola. In terms of revenue, Dr. Pepper yields a small number in comparison to the other two giants. The next two graphs is in relation to the information from the before slide. This graph illustrates the assets to percentage of total assets for Coca-Cola, Pepsi, and Dr. Pepper. When we look at the statistics from a geographic perspective, we will see that Coca-Cola outperforms the other two terms of the cash it holds in relation to its total assets, and it is better positioned to hold. Pepsi holds the most in other current assets, and Dr. Pepper holds the most in long-term assets. However, all three firms hold the most long-term assets than any of the other assets. This graph illustrates the liabilities and equity to percent of total liabilities and equity for each company. By observing each firm's liabilities and equity, we see that Coca-Cola holds the most current liabilities related to its competitors. For the long liabilities, we see that Dr. Pepper holds the most as a percentage of its total liabilities and equity. However, it is important to note that unlike Pepsi and Dr. Pepper, Coca-Cola holds roughly the same percentage of long-term liabilities to its current liabilities. Because Dr. Pepper holds the most long-term liabilities than the other two areas, it probably has a large interest expense. In terms of shareholders' equity, Coca-Cola holds the most compared to the other two, which results in the better option. Is our stock fairly priced? In determining if a stock price is valued correctly, we needed to find the intrinsic value. There are many ways in finding this value, models such as free cash flow, dividend growth over time, and EPS. We determined that EPS would work best for these two companies because it allowed for a close analysis due to their similarities. Therefore, by taking the EPS, earnings per share, and multiplying by the PE ratio, or price earnings ratio. For Coca-Cola, its EPS is 1.97 and its PE ratio is 18.99. When we multiply it together, we get 37.41. With this method, it is safe to say that Coca-Cola stock is fairly priced compared to the stock price at 12/31/12, which is 36.25. By multiplying the PE and EPS together for PepsiCo, we got a stock price of 73.7, which would make the stock overvalue to the value of 12/31/12 of 73.68. In conclusion, PepsiCo had a closer relationship to the stock value even though it was overpriced. Therefore, PepsiCo would be the better choice. In our overall conclusion, with all the information gathered from above, we concluded that Coca-Cola is the better of the two companies analyzed. It held a stronger interest coverage, depth of cost, and depth of equity ratio. In addition, Coca-Cola resulted in better betas compared to PepsiCo as well. Although both companies are successful in their own accounts, according to the analysis that we conducted, Coca-Cola gives us a more confidence in investment. Thank you.